Next, we want to talk about what is a balance sheet. And a balance sheet shows the financial condition of your business on a specific date in time. So, again, let's think about some of the common accounts that we see on a balance sheet. These are going to be different from the income statement. A balance sheet contains assets, liabilities, and equity. So, again, these can include, but are not limited to, your checking account or your savings account, furniture, or equipment that you might have bought, credit cards, any kind of loan payables that you have, owner's contribution, money you put into the business, owner's draw, money you took out of the business, and current year income and retained earnings also show up in that equity section. So, again, we also want to think about time frame. Now, the difference between a balance sheet and an income statement is that an income statement's over a period of time. So it's usually multiple days, months, years, whatever it might be. A balance sheet is actually a picture in time on a specific date. So it's always one specific date. That could be the end of the month, that could be the end of the year, that could be any one specific date. So, for example, you could create a balance sheet as of September 30th. And if you create a balance sheet on October 1st, it's very likely to be different from that because you've had activity that occurred over that 1 day period. That 1 day difference, there's activity that occurred, which is going to change the output of your balance sheet. And so, this is why a balance sheet is just simply a snapshot at a specific point in time, one specific date. Now, what does a balance sheet tell you? Remember, an income statement shows how much money you made and how much you spent. A balance sheet tells you what you own, what you owe, and what's left over. And so typically a balance sheet's going to start with assets. That next you're going to list your liabilities, and then finally you're going to have a section at the bottom that has equity. And remember when we talked about a few episodes back, this is where the accounting equation comes into place. Assets on the balance sheet are going to equal liabilities plus equity. So if you have $100,000 in assets, that means your liabilities plus equity are going to equal $100,000 when you combine them together.